Imagine a 35-year-old father, the sole earner for his family, passes away unexpectedly. In the aftermath, his grieving family opens an old steel safe, reaching for his life insurance file, believing that his years of financial planning have secured their future. For a decade, he faithfully paid a 50,000 rupee premium every year. He bought this policy through a trusted relative, an uncle agent, with the promise that it would provide both a safety net and a guaranteed payout. When the claim is finally settled, the insurance company pays out just 10 lakh rupees. In 2026, that amount barely covers a year of basic living expenses, leaving the kids' college fees and the family mortgage completely unaddressed. This specific gap, a 10 lakh payout after 500,000 rupees in premiums, is the standard contractual outcome of the traditional endowment policy. The company followed the policy to the letter. Millions of Indian professionals hold these exact policies today. To understand if your own family is actually protected, we have to look at the internal mechanics of how these products are built. Traditional endowment plans bundle life insurance and long-term savings into a single annual premium. To see the impact on wealth, we have to look at how that money is actually distributed between protection, commissions, and growth. This chart tracks the long-term math. While the Indian economy averages roughly 6% inflation, the actual annual return, the XIRR, on these bundled policies typically ranges from 4 to 5%. Over 20 years, the purchasing power of that money steadily declines. This growth is further stunted by the costs of the sale itself. In the first year of a policy, as much as 35% of your premium is diverted to fund agent commissions and administrative charges. These high upfront payouts explain why intermediaries push endowment plans so aggressively. The commission structure creates a permanent incentive to prioritize sales targets and agency rewards over the policyholder's long-term financial health. This structure prioritizes the intermediary's immediate income and the insurer's reserves, while the policyholder's capital struggles to keep pace with the rising cost of living. These products are the primary offering of India's largest and most established financial institutions. However, official regulatory data reveals the cost of this trust. The IRDAI has flagged a significant rise in complaints related to unfair business practices and the systemic mis-selling of insurance products. The regulator highlights specific grievances: policies sold with disguised terms, manipulated return charts, and aggressive emotional tactics used to lock middle-class families into unsuitable 25-year commitments. The most critical failure is the protection gap. Because so much of the premium is diverted to fund the savings portion, the actual death benefit is often 500 times smaller than what a pure term insurance policy would provide for the same cost. When the insurance component is starved to fund a low-yield savings plan, the product fails to provide what a family needs most: meaningful financial security. The solution is to separate your protection from your wealth creation. In the 2026 economy, this is known as the decoupled strategy. Buy term insurance and invest the rest. To see the difference, consider a 30-year-old with a 1.5 lakh rupee annual budget. Instead of one bundled policy, we are splitting that budget into two specialized tools. We allocate 10,000 rupees to a pure term insurance policy. This provides an immediate, massive life cover of 1 crore rupees, a payout that can actually sustain a family's lifestyle. The strategy allocates the remaining 1.4 lakh rupees to a transparent, high-growth ELSS equity portfolio, aiming for the 13.6% returns that leading tax-saver funds have delivered over the last decade. After 25 years, the difference is staggering. The traditional endowment path yields a maturity of 76 lakhs. The decoupled strategy, even after accounting for capital gains tax, results in a corpus of 1.65 crore rupees. By separating risk from investment, you secure 400% more life cover for your family today, while generating more than double the terminal wealth for your future. If you are currently paying premiums on a traditional endowment policy, investigate the surrender or paid-up options immediately. Continuing to invest in a low-yield structure often costs more than the exit penalty. For true protection, ensure your term insurance cover is at least 15 to 20 times your annual income. Buy your policy directly online to remove intermediary commissions and prioritize companies with a claim settlement ratio above 97%. Moving toward financial sovereignty means adopting a modern approach. Insure your life, invest your wealth, and never allow a financial institution to confuse the two.